All right, hello everybody. This is Matt Garrett and Bruce Lambright. We're from TGG Accounting and TGG University, and we're going to be talking about the Main Street Loan Program today. There is a lot of stuff going around about this. This program has been out since early April and really just can't seem to get itself off the ground, but could be one of the most beneficial programs that the government and the Fed in specific has put out during this pandemic. And obviously we're waiting to see what happens with Congress in the next few days, whether they're going to extend the unemployment benefits, all these other things that are going to happen. But what we thought we would do today is bring an expert, Bruce Lambright, who's one of the CFOs in our office at TGG, to really answer your questions and get a kind of an idea about what's going on with this Main Street Loan Program. What do we need to know? So again, I'm just going to do a very brief intro to us. We're going to go, I'm going to introduce Bruce, and then I'm going to start asking Bruce some questions that hopefully spur some thought with everybody and can teach you a little bit about what we've got going on. So I'm Matt Garrett. I'm the CEO and founder of TGG. We are an outsourced accounting firm. What we do is make business owners' lives better through excellent financial management by putting in best practices around accounting, processes, procedures, and then people like Bruce who can interpret that stuff and help with advice at the CFO and controller levels. So that's us. I'm going to let Bruce take just two seconds to introduce his background and bio, and then we'll go ahead and get started with this Main Street Loan Program today.
Thanks, Matt, and thanks for inviting me to be part of this. This is exciting. We've spent a lot of time working on this the last few months, and I'm glad to be part of it. My information, my background comes from corporate accounting. Got involved in a sale to a private equity firm, and then a sale back to a private or a public company. And at that point, I had a chance to make a decision. Do I stay in corporate accounting or do I do something like TGG? And the opportunities to do things like this, the variety that we experience in industries and different ownerships, just makes TGG a perfect opportunity for me, and I'm really glad to share my experience here.
Cool. Well, thank you, Bruce. We're obviously TGG is lucky to have you on. So let's talk a little bit about what this means, this Bonfire Chats. It's a little bit of a play on the old Fireside Chats thing that was going on as an evening radio address series that was given by Franklin D. Roosevelt between 1933 and 1944. And if you guys have heard me on previous webinars, I think we're in for very similar economic times that we had in the 30s. What we're looking at is going to be high monetary inflation, high unemployment. We just saw the GDP numbers come through at negative 32%. And the unemployment figures, another 1.4 million people last week filed for unemployment. So we are in a really big world of uncertainty. And being, you know, a Southern California-based company with close proximity to the beach, we decided to name this series the Bonfire Chats rather than the Fireside Chats. So again, at TGG here, clients and the community members reach out to us all the time with questions, especially right now regarding this government loan programs available to small business like this Main Street Loan Program and others. Our goal today is to really share that knowledge and expertise with you so that you can secure the best funding and really look at overall the best financing structure for your business and for your clients' businesses or the people that you might be advising. At the end of the webinar, we'll have a slide with all of our contact information so that if you want to get in touch with us, if you want to send us questions, anything like that, we'll be happy to do that. So let's go ahead and get started here, Bruce. Bruce, what are the basic requirements? First of all, can you give us a little background on what is this Main Street Loan Program? Who's putting it on and how much money could you actually get? And what are the general kind of characteristics of it?
Sure. So maybe while I share my screen here, I should talk a little bit about what it's not. So this is different from the PPP in that it's not a grant, it's an actual loan. We have consolidated the main two facilities of the program into one slide here, and we'll run through those parameters quickly. A 5-year term, principals deferred and repaid in years 3, 4, and 5. Interest deferred for 1 year. The interest rates by LIBOR plus 300 basis points. Loan size is a minimum of $250,000 and I need to do a clarification here. For the new loan, the maximum is 35 million. For the priority loan, it's 50 million. It's calculated based on the size of your EBITDA times a multiplier, for maximum of 4% or 4 times for the new loan and 6 times for the priority loan. And again, emphasis on that's a maximum. So it's not your EBITDA fits, it's times 4 or times 6. That's not how it'll work. They'll do an evaluation to determine that. It's backed by the Fed 95%, and there's no prepayment. You need to have fewer than 15,000 employees or and 5 billion or less in revenue. Who is running this? So it's part of the CARES Act that was passed by Congress and assigned to the Fed. The Fed assigned their Boston affiliate to organize and run this. The link that you can see at the bottom of this page is a link that where you search. Just search Boston Fed MSLP, and it'll take you here, and it'll tell you everything you could possibly want to know about it. 2 things I want to mention from that. Originally, it was set to expire on or about September the 30th. 2 days ago, the Fed extended that deadline, not only on this program, but on all their stimulus programs to December the 31st. So for those who are looking to get money immediately, that doesn't have much impact. But for those that are in the process, and we've taken the limit off or moved the limit out, and we're not in quite such a rush. Another thing that I'd like to point out from this slide that's different from the other programs. So for PPP, you went to a lender, you submitted your information, you probably got your money. With this one, there are some things that can vary from lender to lender. First of all, the loan size is impacted by the EBITDA multiplier. From lender to lender, you will have different items that are accepted as EBITDA adjustments, and which will impact your EBITDA size. Also, they'll evaluate the balance sheet, the financial strength of the company, and come up with different multipliers. One bank may say, we can do this at 2 times EBITDA. Another one may say 3 times EBITDA. The other thing that is variable on here is the last item, the fees. There is a set 1% that the Fed charges, and it may be passed on to the client. The other one is up to 1% that the banks can charge to the client. So that fee structure may change as well. So in this one, I've been advising my clients that we need to look at 2, 3, 4 offers and to make sure we're getting the one that best suits the needs of that particular company.
So Bruce, first of all, can you just, for everybody's sake, define EBITDA real quick?
Sure. So EBITDA is your earnings, your net income, and then you add back to it your interest, taxes, depreciation, and amortization.
And when you say that they're using a multiple of EBITDA, they're taking whatever that is, that net income, with those things that you can add to it. So you can increase your net income by taxes, depreciation, amortization. But it's not a hard and fast 4 to 6 times. You're saying it's anywhere in between there. And then if that's the case, how do you maximize the loan?
So the first step to maximize the loan is to make sure you've included all the possible EBITDA adjustments. And business owners can get very creative at this. So let me point out a few things. An easy one is I settled a lawsuit last year. I can show you my 2018 performance, and it's not on there. There's nothing in 2020. It's settled. It was a one-time expense. So we should be able to add that back to EBITDA. Now, probably the most creative one I got was, well, all of my meals and entertainment should be one-time expenses because I will never eat that meal again. And while that is strictly true, you're probably going to have meals in the current year, so that likely will not be able to be used.
So you've got to be realistic about what sort of adjustments you might make to EBITDA. What else are you finding is winning when it comes to the banks? Because I read this last week that of the $2 trillion they have outstanding, only 14 million has been funded by banks so far. First of all, what's succeeding with the banks? What offers are you seeing when you get them? And what is the thing when you're seeing banks turn it down?
Gotcha. So maybe one thing I should go back into on this sheet is that the main difference between the two different programs is that under the priority loan, you can refinance debt at the onset of the loan. So as you're looking at EBITDA, you take your EBITDA times whatever multiplier is and subtract your current debt commercial debt that you owe. So obviously that impacts what they're going to be willing to offer, because if your EBITDA times 4 is 2 million and you've got 2 million in debt, you now have no capacity for a Main Street loan program. The other thing that's not listed here, these are the Fed guidelines. If you look at the frequently asked questions, I believe it's question F.3, it says that the banks need to use the same criteria that they would normally use to underwrite the loan. So therefore, they're going to look at the strength of the balance sheet, the cash flow of the business, the past performance. I have take an example of a restaurant group who is obviously suffering right now because they're not able to operate at full capacity. However, they had an e-commerce division within their company, and so we're putting together the plans, the cash flow to build on that e-commerce relationship. They already have the infrastructure in place to ship and they can export as well. And so we're pumping that aspect to get them a higher EBITDA, because even though their in-store is down, their e-commerce has a lot of potential. So it's the same basic requirements that you'd look for in any loan. How secure is it for the bank? How strong is the company? And how do we best position it to get the highest loan value? I think you're on mute, Matt.
Common Zoom mistake I make all the time. So what are you seeing, Bruce, as the businesses that are getting the best looks at this? How does a business need to position itself to be successful with this Main Street loan program?
So that varies from bank to bank, and the banks are looking at this program in very different ways. You want to, again, going back to the same way that you would position yourself for any commercial loan. What are your weaknesses, and what can you do to address those weaknesses and show that they're not as impactful or actually a strength? The debt size, the EBITDA, Main Street loan has to be, can't be junior to any other debt. So you've got to make sure you've got debt that you can subordinate to the Main Street loan package. And that's one thing about refinancing debt under the plan. You can do it under the priority, but you have to do it at the time that you're originating the note, and it can't be debt from the same lender that you're taking the MSLP from. So if you've got a loan with Bank of America and want to refinance, you have to do the MSLP from another bank.
Got it. So we got a question from one of our audience members. And the question is, do you subtract the debt from EBITDA? And I think what we ought to do is also clarify what kind of debt, because you said it's commercial debt. It's like accounts payable or payroll liabilities count towards my total debt?
The official guidance I've gotten from the Fed and most bankers is that no, commercial debt is term loans, lines of credit, mortgages, although they'll separate that out a little bit. You have to disclose any idle loans that you got from the SBA, the disaster loans, or PPP. But they do look at the PPP a little differently if you can prove that you're on track for full forgiveness. a debt to a shareholder, let's say an owner puts in 300,000. Most banks are not considering that. I have seen a few banks that on the form, it requires you to put that on the form. And so it's a little bit of variation there. AP and credit cards generally not considered in the debt calc.
So let's say that I had $1 million of line of credit in my business. And let's say my last year's EBITDA was 500,000. What kind of loan could I get?
So if let's figure maximum, if you had 100 EBITDA times 4 is 400. Did you say 400,000 or 100,000? Was that?
Sorry, I said 500,000 of EBITDA and I have $1 million line of credit.
Thank you. So you've got times 4 is a $2 million EBITDA calc, and you've got $1 million on the line of credit. Now, is that the full line of credit, or is the line of credit go higher, or could it go higher?
Well, that's an interesting one. Would you tell us like how that would work? Let's say that I had $1 million line of credit, but I'd only taken $500,000 off of it. And then in the second scenario, let's say I'd drawn out the entire amount of my line of credit.
Yep. And the answer is the same in both cases. It's the total available on the line. So it's the amount you have drawn out plus what you could draw out. So if the cap on the line is $1 million, you've got 2 million prior to that, you potentially qualify for $1 million in a Main Street loan.
Got it. And if my line of credit is at say 4 or 5%, something like that, and this Main Street loan is now at 3.1 or 3.2, whatever that is right now, based on LIBOR, what's your best advice on this, Bruce?
So the other factor to take into consideration is what's your forecast, what's your gut feeling on the future? Are interest rates going to stay low? Is capital going to get tight and interest rates are going to go up? Your line, if it's a fixed rate line, we only need to travel upwards 1% before the line and the Main Street loan would be at the same interest rate. This is an adjustable loan. So we've been looking at that. Each company has a little different view of the world, and that's one factor. But again, we're looking at that, plus we're looking at the fees they're going to charge, plus the multiplier they're going to use to make that total decision.
Got it. And so are there any other sorts of, I don't know, government programs that you would put ahead of this, or things that you would think? We've got the PPP. I think most everybody's heard about that. Are there any other things that most businesses should think about in addition to this Main Street loan program? So
interesting enough, when I started this out, it was all about Main Street loan. That was my assignment: find out about it and work with the clients to get that. As we started talking to lenders also have certain areas of expertise. And so I worked with a bank in Florida who's very strong in healthcare, biotechnologies, and is an SBA expert. And I learned from them that the 7A loans under the CARES Act also have a principal deferment of, it was 6 months, that may have been extended with this announcement 2 days ago. So we're looking into that for one of my clients, but there are variations. The Main Street loan does not require any collateral or personal guarantees. The bank may require them going through their underwriting processes. In fact, I haven't met a banker who won't require a personal guarantee yet. But the SBAs are maybe more advantageous. They have the deferral, but they are required to have some collateral. So you need either equipment or real estate, something that can back up that loan, which is not in the SBA. In a couple of instances, we've even just shifted and talking to the lender about commercial debt instruments that you would normally find. And so I guess the message there is be open and pursue as many avenues as possible so you get the deal that's best for your situation.
Well, it seems to me that you're also saying that we've got to make sure we're forecasting out what we're going to do correctly. We've got another question from one of our guests. So I want to make sure and address those. And thank you, by the way, for sending those through. That'll help us. We'll keep going with these. This question is, I maintain several lending relationships and both banks are saying they aren't participating in this program. What types of banks are giving out these loans? Now I know, Bruce, you're tracking some 50, 75 odd banks that are giving, but there are a number of them who aren't. What's the best way to figure that out?
Okay, that's a good question. So it ranges. There are small regional local banks that are participating in the program, and then there's the big banks, the national banks that are participating in the program. The difference between those banks that you have to sift through is they often limit based on loan size. There are banks that won't do anything under 10 million in loan size, or they won't do anything outside of Southern California, or they won't do anything in the restaurant or cannabis industries. They have lots of different parameters that they work in. So the first step is to try to narrow it down to the list of banks that fits your parameters. Then it's a matter of having the information at hand and in an organized fashion to present to the bankers and get them interested. So that ranges. Is it you've got a big new idea and we need to forecast out how that's going to differ from your historical performance? You're a restaurant group who's in real tough times right now, but you've got a plan once the economy starts coming back, and what do you think that's going to look like? Is that helpful?
Yeah, absolutely. So it seems like what we've got to do is get out and get organized, and then make sure that we're shopping it around, because your existing bank may not work for it. But there are a number of banks that are looking, and they may be industry specific too. So you actually have to know what banks are doing what. So that was helpful. Tell me a little bit about, we got another question up here about compensation and distributions. With the PPP, obviously compensation was limited. Is compensation limited under the Main Street Loan Program?
The answer is yes. The threshold you want to look at is people, members of your organization who in 2019 received more than $425,000. They are limited to that $425,000 going forward. There are some loopholes that can get you up to $3 million, but I'd really rather take those on a one-off basis because they've got a lot of dynamics to them. As far as distributions were originally not allowed for the term of the loan plus 1 year thereafter. However, they made a change early on to allow pass-through organizations, mainly S-corps and LLCs, to take distributions in order to pay the tax generated by the business.
Yeah, I have seen a number of different ways to get around sort of the distribution issue, but the compensation issue is one that I think people need to take pretty seriously. I just read a story 2 days ago about a man who took in Florida, took a bunch of money on the PPP loan and went and bought a Lamborghini, and he's very quickly should have been charged with fraud. So I think really important that we remind all of our listeners here on this that whatever they do, they have to be doing in good faith and with good solid business practices. Okay, there was a question out here: is the 5% a factor in the amount of the collateral? Meaning, if the Fed is going to be guaranteeing 95% of this, is the bank going to think about it as, well, then we need to come up with 5% of collateral, or are they going to think, no, we need to come up with more like 50% of the loan in collateral?
Because they're evaluating and underwriting based on their normal practices, this really doesn't become a factor because they have to approve the loan as at a safe level or above. I guess in my brain, when we started this program, I thought my main job was going to be talking companies out of taking too much money that was too risky for them. Because the Fed kind of implied with this that, hey, we're going to take on 95% of the risk. And so maybe the banks would be a little more creative. but then they put in that you must adhere to your normal underwriting practices. So the bank is saying, no, the company needs to show that they're going to be able to service this debt as we go along. So all it means is that instead of the bank coming after you for 100% of the loan, if you default, you've got the Fed and the bank coming after you in case you default.
So let's, we're here, we've got a few more minutes left, but I've got some really good questions coming in. So I'd like to make sure we get to those. We'll try to answer them as fast as we can. If we have a service business, if somebody has a service business and they're very asset light, so not a lot of collateral there other than maybe accounts receivable, any advice on whether it's worthwhile to pursue the Main Street loan for this type of a business? And do you know of any banks who are lending in this? I mean, obviously we're a service business.
Yeah, and service business incorporates a lot of different situations. So I have clients who are more on the healthcare, beauty lines that are service businesses, and they were impacted almost as much as the restaurants were. So it's a very different scenario than an accounting firm. It is not, I wouldn't discourage them from, it doesn't cost anything to apply. I would want to make sure first they exhausted their idle loan and PPP opportunities. But sure, definitely apply.
Yeah, and I will say personally, we did get an offer for our business with the Main Street Loan Program with one of our banks. So we do know banks that are lending to those service businesses. What about construction and how these banks will look at the bonds that the bonding companies and the sureties that the bond sureties that these construction companies might have? How would that interact with the Main Street Loan Program? So
as long as you're operating within the guidelines of the industry and the bonding agency, I'm working with a construction firm right now, and that has not been an issue at all. So construction is definitely qualified. Where you get in, you want to make sure you're an eligible business, and a real estate holding company is not an eligible business, or private equity held companies. You sometimes can apply under the subsidiary, the operating branch of that. But yeah, there should be no limit on construction itself.
Got it. I've got about 6 or 7 other questions here, but I want to respect everybody's time. I know, Bruce, you and I can stay on board here afterwards if you've got the time.
Yep.
And continue to answer these questions. But I do want to give a little quick closing here in case people have to sign off at 2:30 Pacific time. So anyway, let me first of all thank you, Bruce. I want to thank Katie in our office for putting this thing together. These TGG Bonfire Chats are going to be a recurring webinar series that we're going to hold every 2 weeks while all this stuff's going on, just in an effort to get you guys the most up-to-date information, not just on Main Street loan programs, but on anything that comes out, any new government programs, any new tax issues, any business opportunities that we see. We would love if you have a suggestion on any tips or suggestions for that Bonfire Chat series. Please email us at info@tgg-accounting.com. We also will share here at the end a link to our Main Street Loan Toolkit organizer. So we're big believers in getting organized and obviously staying organized. We're an accounting firm and believe that the best way to shop these things to different banks is to make sure that you've got all your eggs organized. And that's what we've put together with our organizer. Also, please submit any questions to me if you'd like to in the future at matt.garrett@tgg-accounting.com or Bruce Lambright at bruce.lambright@tgg-accounting.com, and you'll see both of our emails are there on the screen. So it's just about 2:30, but Bruce, if you're okay, I'd like to just keep going through some of these questions. Is that okay with you?
Yep, I'm available.
All right, well, let's keep doing this here. Let's see. I'm going to read this question as best I can. Do those banks that participate in this program require the full relationship be moved to them?
That varies. Some banks do. All banks would be happy to have that happen. There are banks that their marketing ploy is you don't have to move all your banking relationship to them.
would you generally see it as a, let me say it a different way. Would the banks generally see it as a benefit if you thought about it and you were open to it?
Yes, absolutely.
And is it the deposit relationships they want, and is that sweeten the pot? What do you see as the biggest thing that they're looking at and saying, that's really what we want out of this? Like a credit card relationship processing, or is it, what is it that's the more important thing for them? They're getting these fees for origination, but it seems like those fees may not be, quite enough to sweeten the pot for them.
Yeah, the fees themselves are not attractive unless you can do volume for the banks. So they're definitely, and the other thing that the banks are telling me is that, we now have to do the full underwriting process. We go through that whole, I was going to use ordeal, but maybe that's not positive enough. We go through the whole process, and so we've done the legwork, and now we're giving 95% of the business to the Fed. We would rather maintain and build that relationship with the client so that we have them there for the deposit relationship, the credit card relationship, the next line of credit they need down the road. Why go through all that work and then just turn the business over? So that, I think that is one of their reasons. I think the fees is a big one as well. So yeah, they're open to it, and it's as much or as little as you want to go. You can negotiate that.
Got it. Next question here was, I know these loans initially said they weren't going to require guarantees. Is this what is happening in practice, or are banks still wanting the guarantees for the 5%? It seems like what you said earlier is that most banks that we know of, that you know of, are looking for personal guarantees. Although I will say I've seen a couple that didn't, but for the most part, that's what they're looking for. Is that your experience?
Yeah, that is definitely true. Remember, it really has nothing to do with before you get to the 95.5, you have to pass the safe hurdle in their underwriting processes. And in order to get to the safe level, they have to have enough security or strength of the financial balance sheet in order to qualify that as safe. And one of the ways they can move you up the line of safe is to get a personal guarantee. So they're requiring it.
Yeah, we got a comment in here. Audited financial statements help mitigate no guarantees as well. We also got a question of what is a personal guarantee? Maybe you can just in 10 seconds tell us what that is.
Sure. So I guess in simple terms, you're guaranteeing the loan as well as the business. So the loan is in the name of the business, but you're saying I pledge my personal assets to back this loan as well.
Got it. That's great. Thank you. Any tips on reaching out to participating banks? This is somebody says, I've reached out to half a dozen banks listed on the Boston Fed's website and received no response from them. What availability do you have, Bruce, in being able to get people in kind of the back door, if you will?
Sure, it's a good question, and I'm happy to work with anybody on that. If my inbox gets flooded, I'll find volunteers to help me. So definitely contact me. The website, it's great that they put that website on the Fed website, but the list is, first of all, only banks who allowed their names to appear there. So there are a lot of banks that aren't on that site that are lending. And what we're finding is the banks on that site are getting deluged by inquiries, and so it slows down the process, and that's one of the reasons people might not want to be on that list. But yeah, you've got my email address down there at the bottom. Give me a shout.
Yeah, and Bruce, can you just give us that Boston Fed website address one more time? Just
absolutely. Can I share the screen quickly, and then you can see it.
Perfect.
Let's see here. So down here at the bottom, basically, it's a long address, but if you go out and search bostonfed.org and then go to the Main Street Loan Program section.
That's where you get it. Great.
You'll find it.
I've got two more questions here, and then we'll kind of wrap up here. Does the Main Street Loan Program allow previous SBA loan penalties to be waived?
Say that again.
Yeah, I'm not sure I understood the question exactly either. That's why I was asking it to you, hoping that you'd actually understand it better than I did. Does the program allow SBA loans and penalties to be waived? And I'm trying to figure out, I think maybe what they're getting at is prepayment penalties. If you refinance the Main Street loan with an SBA, but you have SBA prepayment penalties, would those get waived in this sort of a transaction?
The general answer would be no, because it's the terms of the loan. But because these are extraordinary times, the CARES Act is a humongous document, and I would ask the question. But I guess to be safe, I would say no.
Great. Thanks, Bruce. Well, Bruce, thank you so much for your time today. I think what we've learned today is that the Main Street Loan Program is a little more complicated than we thought it was, that we need to get organized. We need to shop banks. We definitely need to take a look at it, because who knows what's coming with the economy, and we really need to start building a strategy for financing our business. And the Main Street Loan Program or other SBA loans may be a great option, and the EIDL loans, all these other things, all different options in here. Main Street Loan being a very important one to check out. Once again, thank you so much for everybody. Let's see. I just got a question. Could you put the slide with the emails on them again, please? Bruce, would you put that, see if we can put that up there, or Katie, if you're listening, if we can get the slide with the email addresses up there again, we'll do that. Once again, thank you everybody for joining in. We'll let you know what our next topic is going to be in 2 weeks. We are very appreciative for you joining us today. If you've got any topic ideas, again, email us. We'd love to hear what you'd like to hear about, and love to be able to serve you during these really tumultuous times. Thanks again.